In this video, we're going to move into the next step of our equity value and enterprise value videos, which is actually calculating the enterprise value for Apple. Now, in the previous video, we saw the basic definition and how you should think about enterprise value versus equity value conceptually. The equity value is sort of like the list price of a house, and then the enterprise value is the true cost to actually buy the house. When you subtract out any cash or investments you get as a result of the purchase, and then you add back onto the price any liabilities, unpaid obligations, anything else that you're going to have to pay as a result of acquiring the company or acquiring the house. So now what I want to do is go into Apple's 3 financial statements here and also go through their filings where necessary, and we're going to go through and calculate their enterprise value based on their fiscal year 2009 numbers here. So let's start with cash and investments. And this one we can actually just pull directly from our balance sheet. So let me go down to the balance sheet. So we obviously want to add in cash and cash equivalents. There's always a question here whether we should include short-term securities and long-term securities. Most of the time, you're going to want to include cash and cash equivalents and any type of short-term investment. The reason being that short-term investments are more liquid and are therefore easier to turn into cash versus long-term investments. So most of the time you include at least these 2 items. The treatment of long-term securities differs based on the bank and group you're at. In our case here, we're going to go with the most conservative estimate, which is to include long-term securities. So we're going to count this as a cash item. Now, if we want to be technically correct here, we would probably want to consult with the CFO of the company or the finance department and see what actually goes into these long-term securities and how easily they can be converted into cash. If they're highly illiquid, then maybe it's not accurate to add them. But in our case here, without further information or more detailed information, we're just going to make the assumption that we should be counting them. So we're going to add them to our cash and investments number here. Now, for debt, once again, we're going to go to our balance sheet. And you see under liabilities that there's only one line item here for debt, which is this long-term debt number right here. It's 0 for 2009 because we only have the debt appearing in 2010 and onward. Remember that when we calculate enterprise value, it's at a specific point in time. So it doesn't make sense, for example, to look at enterprise value for 2010, 2011, 2012. We're only going to look at it at the present point in time, at the current point in time for the end of 2009 right here. So we're just going to link to our long-term debt here, which is 0. Now, for minority interest, this is also usually listed on the balance sheet. This and preferred stock should usually be listed on the balance sheet. But if we go down to our balance sheet, we actually do not see anything here for minority interest or preferred stock. So let's go back up. Now, since they're not on the balance sheet, the next thing that we want to do here is look in the filings and see if we can find them there. Before I do that though, just to briefly explain what these items actually mean, minority interest refers to cases where Apple owns over 50% of another company. And what you have to do in this case is add the portion they don't own to enterprise value. Now, the reason you're doing this is because when Apple owns over 50% of a company, the company's full earnings, their profit, revenue, everything like that will be reflected in Apple's income statement down here. So the financials from the company that they own a majority stake in will be reflected down here. But the problem is that unless we actually add this to enterprise value, then nothing to reflect the value of the company that they own is going to show up here. So that's why we have to add minority interest, because the financials from this company are already reflected in Apple's financials, but we are not yet reflecting the value of this company that they own a majority stake in. So that's why we need to add it in right here. Preferred stock, by contrast, operates more like debt. Preferred stockholders get a guaranteed dividend from the company, similar to some of the other items that we saw with common stock dividends, for example. So they get a guaranteed dividend, usually equivalent to some type of interest rate on the preferred stock, and they also have a higher claim to the company's assets than the equity investors, the shareholders. They're lower on the totem pole than debt investors, but they're higher up than equity investors. And so preferred stock is usually counted as a debt-like item because it carries with it interest that must be paid to these shareholders, and because if we acquire this company, then presumably we're going to have to repay the preferred stock to the investors and pay off that obligation. Now, just to double check and make sure that there really is nothing for these, I'm going to go to Apple's 10K right here, and I'm going to do a search for minority interest. We see that minority doesn't even appear anywhere in Apple's filing, so there's nothing for that. I'm also going to do a search for preferred, and here we see the company has 5 million shares of authorized preferred stock, none of which is issued or outstanding. So it's saying right here there is no preferred stock in this case. So I'm going to go back and enter 0 for minority interest and 0 for preferred stock. Now this other liabilities item, we're going to go into more detail on this one in the next video, but suffice to say that oftentimes with companies you have other types of obligations and liabilities that must be repaid as well. To show you a few examples of this, let's go back to the filing again, 10K. And I'm just going to scroll to the top here. One type of obligation that sometimes the company has to repay are pension obligations. We see that I just did a search for pension and it doesn't even appear in the filing, but essentially pension obligations are owed to employees that are retiring and they're guaranteed payments to the employees. Some companies, such as the auto manufacturers in the US, got into a lot of trouble as a result of these pension obligations. They should definitely be added to enterprise value because they represent, similar to debt, an obligation or liability that has to be repaid at some point in the future. And any acquirer is going to look very closely at pension obligations. Another item that we could add in here is what's known as capitalized leases. I'm going to just do a search for this right now for leases. And we see here under this category off-balance sheet arrangements and contractual obligations, we have operating leases, purchase obligations, asset retirement obligations, and other obligations. So the issue here is that sometimes a company's leases are really more like debt because they give the company ownership of some type of asset after a period of time, or they're really more similar to a company raising debt to purchase an asset at some point in the future. So sometimes we have to change a company's operating leases to capital leases. For right now, I'm not going to bother with this, so we're going to go back to our Excel spreadsheet and I'm going to enter 0 for other liabilities right here. Other examples of what could appear under other liabilities might be environmental obligations or environmental liabilities. So maybe they have to repay the government for some type of environmental damage or some type of other liability like that. So that could be another one right here. We're going to save the detail on these for the next video where I go into some advanced additions to the enterprise value formula, but keep that in mind for now that other liabilities here is just sort of a catch-all for any type of obligation that doesn't fit into these categories above that still needs to be added to enterprise value to reflect the fact that it has to be repaid at some point in the future, or that if we acquire this company, then we as the buyer have to repay it, and so it's going to add to the true cost of the company. For now though, I want to get to our enterprise value calculation, so I'm going to go up to equity value, I'm going to subtract cash, I'm going to add debt, add minority interest, add preferred stock, and then add other liabilities. We see that the enterprise value for Apple comes out to 141 billion, significantly lower than the equity value because of our huge cash balance right here. And so that takes us to the end of our calculation for enterprise value for Apple. So now you should have a better understanding of where we get these numbers from, whether it's our own projections or by looking in the company's filings to find new items or to double check our existing work. You should have a better idea of that. And coming up in the next video, I'm going to go into more detail on this line item, other liabilities, and we'll be going through a couple examples of additional items that we may add to our enterprise value formula right here, such as the capitalized leases, the pension obligations, and also some other additions on the cash and investment side. So we're going to cover that in the next video in this series.